If you have a checking account and you're over 60, there are new IRS-related reporting and monitoring changes you need to understand right now. These updates affect how deposits are tracked, how discrepancies are flagged, and how automated systems compare your bank activity to your tax return. And the reality is simple. Most seniors don't know these changes happened. This isn't about criminal behavior. It's not about assuming you've done something wrong. It's about awareness. The IRS now relies more heavily on automated matching systems. When deposits, transfers, or digital payments don't clearly align with reported income, those systems can generate notices automatically. No warning, no phone call first, just a letter. Many retirees believe that if their income is modest, or if their deposits come from savings transfers or family reimbursements, there's nothing to worry about. But today, unexplained patterns, not just income, can trigger questions. You don't want to find out about these rules the way Robert did when a letter shows up. Let's walk through what changed and why checking accounts are now under more attention than ever before. Over the past few years, the IRS has gone through a major modernization shift. More funding has gone toward technology, data systems, and automated enforcement tools. What does that mean for you? It means far more digital reporting, faster cross-checking of information, and computer-driven flagging systems that compare what banks report with what shows up on your tax return. Banks now transmit more structured data. Payment platforms generate electronic tax forms. Artificial intelligence systems scan for patterns that suggest underreported income. Instead of relying primarily on manual audits, the IRS increasingly relies on automated matching programs that identify discrepancies in seconds. Here's the key point. Social Security income itself is not the problem. Pension deposits aren't automatically suspicious. Required minimum distributions aren't red flags. The issue arises when total deposits flowing into a checking account don't appear to match the income reported to the IRS from known sources. When deposits are organized, documented, and consistent with your return, there's typically no stress. Clean records mean smooth sailing. But large or repeated unexplained deposits, especially cash or digital transfers, can generate questions. This doesn't mean the IRS assumes you're doing something wrong, but their systems don't know context, only numbers. The first rule change involves something many retirees still use: cash deposits. Let's clear up one of the biggest areas of confusion: large cash deposits. There is a long-standing federal rule requiring financial institutions to file a currency transaction report, or CTR, whenever a customer deposits more than $10,000 in cash in a single transaction. This isn't new, but enforcement and automated tracking have become more sophisticated. The form goes to the Treasury Department, not just the bank's internal records, and it creates a permanent reporting trail. Here's where misunderstandings start. Many seniors believe, if I deposit $9,000, I'm safe. Others think the rule only applies to businesses. Some assume it only matters if they owe taxes. All three assumptions are wrong. Banks are required to report cash transactions over $10,000, but they are also required to monitor for structuring, which means intentionally breaking up deposits to avoid that $10,000 threshold. If someone deposits $4,000 on Monday, $3,500 on Wednesday, and $2,800 on Friday, the pattern itself can trigger scrutiny. Even if the money is legitimate, deliberately splitting deposits to stay under the limit can raise red flags, and this applies regardless of your age, income source, or retirement status. Here's the hidden risk many retirees overlook. Perfectly legal cash can still generate attention. Selling a car for $12,000 in cash, receiving cash from an estate distribution, accepting a large cash gift from a relative, downsizing and selling antiques or collectibles. None of these are illegal, but once deposited, they create reportable activity. Imagine a widow who sells antique furniture for $14,500 in cash after her husband passes. She deposits it in smaller amounts over 2 weeks because she doesn't want trouble. Months later, she receives an inquiry asking about unusual deposit patterns. The issue wasn't wrongdoing, it was the appearance of structuring. So how do you protect yourself? First, never intentionally split deposits to avoid reporting. That creates more risk, not less. Second, keep written documentation of the cash source. a bill of sale, a written receipt, a simple signed note, anything showing where the money came from. Third, when possible, use a cashier's check instead of accepting large amounts of physical cash. Checks create a clearer paper trail. Fourth, maintain a basic deposit log. Write down the date, amount, and source of any significant cash deposit. It takes minutes and can save months of stress. When a sale is documented, explaining a deposit is simple and fast. When there's no paperwork, it can turn into frustrating back-and-forth communication. But cash isn't the only thing drawing attention anymore. Digital transfers are the next big shift. The second major shift involves digital payment apps and something called Form 1099-K. Platforms like PayPal, Venmo, and Cash App now operate in a much more structured reporting environment than they did just a few years ago. Online marketplaces that process payments for sales, whether you're selling crafts, collectibles, or household items, also fall under these rules. Zelle works differently because it's typically bank to bank, but activity there can still be visible through traditional account reporting. You've probably heard about the $600 reporting threshold. That discussion caused a lot of confusion. While implementation has been phased and adjusted, the direction is clear. Reporting thresholds have been lowered compared to the past, and enforcement systems are becoming more consistent. The key point for 2026 and beyond is that many platforms now issue a 1099-K when payments exceed certain limits, especially if transactions are categorized as goods and services rather than personal transfers. Here's the core issue. The IRS may now receive visibility into digital payments that previously went unnoticed. Many seniors assume personal transfers aren't tracked, but certain patterns can now generate tax forms automatically. Consider common situations. You sell handmade quilts online and receive payments through PayPal. You help organize a church fundraiser and get reimbursed digitally. You front the cost of a vacation rental and friends send you their share. Your son repays a $2,000 loan through a payment app. Individually, these may seem harmless. But if transactions are coded as business-related, a 1099-K could be issued showing the gross amount received. That's where the hidden danger lies. The form reports total payments, not profit. If you sell $3,200 worth of personal household items that originally cost you $5,000, you have no taxable gain. But the IRS computer only sees $3,200 reported under your Social Security number. Imagine a retiree who receives a $3,200 1099-K and assumes she now owes tax on the full amount. In reality, if she sold items at a loss, there may be no taxable income at all. The problem arises if she ignores the form. The IRS matching system compares that 1099-K to her return. If it's missing, an automated notice may follow. Protection here is straightforward. First, separate personal and business activity whenever possible. If you regularly sell items or run a small side activity, consider a dedicated account. Second, track the original cost of items you sell. Without a record of what you paid, it's harder to prove there was no gain. Third, carefully reconcile any 1099-K you receive before filing your taxes. Make sure the totals match your records. Fourth, never ignore a tax form even if you believe it's incorrect. If necessary, dispute errors directly with the platform and document the correction. Correct reporting often means no additional tax owed. Ignoring the form can trigger an automated mismatch notice. And now there's a third shift that surprises many retirees, especially those helping family. The third shift involves large transfers, especially those between accounts or family members. Many seniors assume that moving money around is invisible as long as it's their own funds. But patterns matter more than ever. Let's clarify a few common situations. Moving money between your own checking and savings accounts is perfectly legal and not taxable. However, if those accounts are at different institutions, reporting trails still exist. Gifting money to children or grandchildren is also legal. Adding your name to a child's account for convenience or caregiving purposes is common. Estate distributions after a spouse passes are routine. The key issue isn't legality, it's documentation and reporting thresholds. Under current rules, you can give up to the annual gift exclusion amount per person, per year, without filing Form 709. Most retirees will never owe actual gift tax because of the high lifetime exemption. But if you exceed the annual exclusion, you may be required to file a gift tax return even though no tax is immediately due. Here's the hidden risk. Frequent large transfers that don't match your reported income can attract automated review. For example, helping an adult child with a $40,000 home down payment, paying medical bills directly on someone's behalf, co-signing a loan and transferring payoff funds. These are generous, responsible actions, but without records, they can look confusing in isolation. Protection is simple but intentional. Document the purpose of significant transfers. Keep notes, copies of checks, or written agreements. Understand annual gift exclusion limits before making large gifts. Avoid unnecessary commingling of funds between family members. And always keep estate funds separate from personal accounts whenever possible. A planned gifting strategy brings peace of mind. Casual, undocumented transfers can create confusion later. So what actually triggers an IRS notice and what doesn't? Let's simplify this. Most IRS notices aren't generated by human investigators reviewing your personal finances. They come from automated matching systems that compare information reported to the IRS against what appears on your tax return. The most common triggers include income mismatches, where deposits or reported payments don't align with your filed return. Unreported 1099 forms, whether from banks, brokerages, or digital platforms. Repeated high cash deposit activity that generates multiple currency transaction reports. And underreported self-employment income, even from small side activities. Now here's what doesn't typically trigger attention. Social Security deposits alone are not red flags. Routine pension payments landing in your checking account are expected. Required minimum distributions from retirement accounts are already reported by your financial institution. Normal bill payments flowing out of your account are invisible to IRS matching systems. The IRS computer doesn't see your life story. It sees numbers that don't match. Common avoidable mistakes include forgetting to report a 1099 you received, depositing large undocumented cash without records, ignoring a 1099-K from a payment platform, and failing to file a gift tax return when required. Each of these creates a mismatch. Each mismatch can generate a letter. If you want to stay completely protected, here's the simple system financial planners recommend. Here's a simple 5-step protection plan that keeps you ahead of problems without adding stress. Step 1. Conduct an annual account review. Before filing your taxes, compare total deposits in your checking account to the income reported on your return. If something looks significantly higher, identify why. Transfers, gifts, reimbursements, write it down. Step 2. Maintain a deposit explanation folder. This can be a basic manila folder or a digital file. Keep copies of bills of sale, gift notes, bank transfer confirmations, and any unusual deposit documentation in one place. Step 3. Separate income types whenever possible. Retirement deposits in one account. Side income in another. Reimbursements clearly labeled. Clean separation reduces confusion. Step 4. Review every 1099 form before filing. Match them against your records. If something is incorrect, address it before you submit your return. Step 5. Know when to call a CPA. If deposits are complex or you receive a notice, get guidance. But for simple documentation and organization, you can handle it. This isn't complicated. It's about organization, not fear. Let's look at a few real-life outcomes. Case 1. Linda, age 68, sold hobby items online throughout the year and received a 1099-K for $4,100. She assumed it didn't matter because she hadn't made a real profit. When she filed her return, she left it off. 3 months later, she received a mismatch notice showing unreported income. What followed were letters, time on hold with the IRS, amended paperwork, and weeks of anxiety. In the end, she didn't owe much, but the stress was enormous. Case 2. Daniel, 74, also received a 1099-K, but he kept a simple spreadsheet showing what he originally paid for the items he sold. When a small inquiry letter arrived, he mailed copies of his records with a short explanation. The issue was resolved with one response: No penalties, no prolonged back and forth. The difference wasn't income level or intelligence. It was preparation, stress versus confidence, confusion versus clarity. So what should you do right after watching this? Start with a simple review. Look back at the past 12 months of checking account deposits. Do the totals generally make sense compared to the income you reported or plan to report? Next, check whether you received any digital payment tax forms, especially a 1099-K from PayPal, Venmo, Cash App, or an online sales platform. Don't assume you would remember. Log in and verify. Then, gather documentation for any large deposits. Car sales, downsizing proceeds, gifts received, estate distributions. Place copies of receipts, bills of sale, or written notes into one organized folder. Take a few minutes to understand current annual gift exclusion limits if you've transferred significant funds to family members. If you exceeded the threshold, determine whether a simple Form 709 filing is required. And finally, avoid intentionally splitting large cash deposits to stay under reporting limits. That strategy often creates more attention, not less. You can complete this entire checklist in an afternoon. Give yourself 7 days. Put it on your calendar. A short review now can prevent months of unnecessary stress later. Here's something many retirees overlook. It's not just the IRS paying attention. State tax agencies often receive and share data with federal authorities. That means the information reported on your federal return, including 1099 forms and income totals, can be matched against your state return as well. If there's a discrepancy at the federal level, it may trigger a notice from your state. In some cases, even if the IRS issue is small or quickly resolved, your State Department of Revenue may send its own letter asking for clarification. For seniors living on fixed incomes, that can feel overwhelming, especially if you thought the matter was already settled. This doesn't mean states are targeting retirees. It simply reflects modern data sharing systems. Automated matching programs don't stop at the federal border. They compare wage statements, retirement distributions, and reported income across agencies. The lesson is consistency. Make sure the income you report federally matches what you report to your state. Reconcile every 1099. Keep your documentation organized in case either agency has questions. When your records are clean and your reporting is consistent, federal and state systems align smoothly. That alignment is what protects your peace of mind. Let's clear up a few myths that continue to cause unnecessary trouble. Myth number 1, small deposits don't matter. Reality: a single small deposit may not matter, but patterns matter. Repeated unexplained deposits, especially cash or digital payments, can trigger automated review, even if each one is under a certain amount. Myth number 2, the IRS only audits the wealthy. Reality: high-income taxpayers do face scrutiny, but automated mismatch notices go out at every income level. Many letters are computer-generated, not hand-selected. Retirement income does not make you invisible. Myth number 3, personal Venmo isn't visible. Reality: while personal transfers between friends are treated differently from business transactions, payment platforms still operate within federal reporting frameworks. If payments are categorized as goods and services or cross-reporting thresholds, tax forms can be issued automatically. Myth number 4, Social Security recipients don't get audited. Reality: receiving Social Security does not shield you from compliance rules. While Social Security itself is properly reported, discrepancies involving other income sources can still generate notices. The common thread here is misunderstanding how automated systems work. The IRS isn't judging your intentions, it's comparing numbers. When you understand the rules, most of these risks become manageable and preventable. Knowledge replaces fear every time. This conversation isn't about fear, it's about awareness. The rules surrounding bank reporting, digital payments, and large transfers have evolved. Technology has changed. Monitoring systems are faster and more automated than they used to be. But the vast majority of problems seniors face with the IRS don't come from wrongdoing. They come from confusion, missing paperwork, or simple misunderstandings. And the good news? Most of these issues are completely preventable. When you review your deposits once a year, reconcile your 1099 forms, document large transfers, and understand basic gift thresholds, you dramatically reduce your risk. Organization equals protection. A small amount of planning now can spare you months of stress later. Remember, automated systems don't see your intentions. They don't know that you were helping a grandchild, selling personal items at a loss, or moving money between accounts. They only see numbers. Your job is to make sure those numbers make sense on paper. You've worked too hard to let a paperwork misunderstanding create stress in retirement. So here's your next step. Share this information with your spouse. Forward it to your adult children or the person who helps you manage finances. Sit down this week and review your checking account activity from the past year. Put it on the calendar and get it done. And if you want to stay informed about changes that affect seniors' financial security, make sure you subscribe and stay connected. Staying updated is one of the simplest ways to protect everything you've built.